All right, let's get into it. Today, we are tackling a massive economic puzzle. Seriously, the market right now feels like it's in this state of what one big institutional report is calling a compressed equilibrium. And that's just a fancy way of saying it's this incredibly tense, artificial balance that feels like it could just snap at any second.
So here's the big question, right? We're digging into this deep dive report from March 10th, 2026 to try and figure out this central mystery. On one hand, you've got the economy flashing all these recession signals, but why on earth are stocks just shrugging it all off?
And this really lays out the paradox perfectly. I mean, look at this. On one side, you've got the economic reality, a shocking loss of 92,000 jobs in February, unemployment ticking up, real stagflation fears. But then you look at the market action. The S&P 500 is at 6,781, AI stocks are just soaring, and credit spreads are tight. It's like we're living in two completely different worlds at the same time.
Okay, so Act 1. Let's start with the economic reality check. Before we get into the crazy market stuff, we need to get grounded in what's actually happening in the real world, the signals coming from the bedrock of the economy.
And this is the number that should be setting off alarm bells everywhere. A loss of 92,000 non-farm jobs last month. I mean, this isn't just a small miss or a blip on the radar. No, this is a full-blown recessionary warning signal. It's screaming that the labor market is in real trouble.
So what does that do? Well, it puts the Federal Reserve in an absolutely impossible position, a perfect trap. You see, with unemployment jumping to 4.4%, the economy is telling them, hey, you need to cut rates. But then you have sticky inflation with core PCE still at 2.9% and oil prices going wild, which tells them they absolutely can't cut rates. They are completely boxed in with no good moves. And this feels eerily similar to the setup we saw right before the dot-com bust.
Okay, so that's the scary economic picture. Now let's completely switch gears and step into the market's alternate universe. It's a place where it seems like none of that bad news even exists.
So you have to ask, how is the market just brushing all this off? A major recession signal? Pfft, whatever. Well, it seems like investors have collectively decided to put on blinders and focus on one and only one powerful story, the AI narrative.
And this quote from the report just hits the nail on the head. It says the market is thoroughly ignoring the real economy's downturn, fixated only on the single narrative of AI infrastructure and CapEx. Basically, forget jobs, forget inflation, forget geopolitics. The only thing that matters, the only story being told, is that companies are going to spend billions on AI, and that's it. That's the whole thesis.
And just look at how narrow this whole thing is. This chart is incredible. The top 10 companies, just 10, now make up over 40% of the entire S&P 500's value. To put that in perspective, that's the most concentrated this market has been in more than 30 years. It's even more top-heavy than it was at the peak of the dot-com bubble. That's wild.
But look, a good story, even a great one like AI, isn't enough to fight gravity forever. So if the real economy is so weak, what's really going on? What are the hidden engines, the mechanical forces that are actually propping up stock prices day in and day out?
Well, the report points to three key forces that are basically defying economic gravity. We've got the liquidity glitch, the options trap, and late cycle complacency. And get this, these have nothing to do with how well companies are doing. It's all about the market's plumbing, the inner workings creating this artificial and maybe super fragile stability.
First up is something the report calls the straw effect. It's a great analogy. Just imagine there's a big shared milkshake of investment money out there. Well, the mega-cap tech companies are sticking in these giant straws and sucking up all the capital for their AI projects. I mean, Amazon alone is raising over $37 billion. They're drinking everyone else's milkshake, leaving the rest of the market completely starved for cash. Okay, the second force is this options trap. It's a bit technical, but here's the gist. There's a crazy amount of short-term options being traded, like zero-day to expiry options. This forces the market makers, the folks on the other side of the trade, to constantly buy and sell stocks to hedge their positions. What happens is it creates this weird magnetic force, a gamma pin, that literally pins the market in place. It's like there's a giant call wall right around the S&P's 7,100 level, and the market just can't break through.
So you've got this weak economy, a single narrative, and these weird mechanical forces. It's a total mess. How does this all end? Let's move to the final verdict and see what the report says we should be looking out for.
The report basically boils it down to two distinct scenarios. Scenario A, the rally keeps going.
The trigger for that? A low CPI report. That would cause a massive short squeeze and send us flying past 7,100. The strategy there would be to overweight AI and maybe some defensive utilities. But then there's scenario B. The drop begins. All you need is a high CPI report or an oil spike, and that forces all the big automated funds to start selling. The line between these two outcomes is razor thin. And get a load of this number. This shows you just how fragile things are. A drop of only 3.5%. That's it. A tiny move down from here could trigger an estimated $86 billion in automated selling from CTA funds. That is a ton of selling pressure just sitting there waiting for a trigger. But okay, beyond those two known paths, the report warns about a potential black swan. You know, that one big risk that nobody is talking about because everyone is so obsessed with AI, a real tail risk that could come out of nowhere. And where is this risk hiding? In the $1.7 trillion private credit market. This is basically a giant shadow banking system that loans money to risky companies that can't get traditional bank loans. The problem is, with interest rates so high, these borrowers are really starting to feel the strain. If a wave of them starts to default, well, that could trigger a systemic freeze, kind of like what happened with subprime mortgages back in 2008. And nobody wants a repeat of that. So after all that, what's the final verdict from this institutional report? Is it time to buy or sell? Well, the answer is neither. The final verdict is neutral. They're basically saying we're stuck in that compressed equilibrium, a tense standoff between the bulls and the bears where something's got to give. And this final quote really says it all. The market can ignore gravity with derivatives and liquidity, but the bill from leverage can never be avoided. It's the key takeaway. Yeah, the market can stay afloat for a while on these weird technicals and a good story, but eventually reality bites back. The laws of economic gravity always win. And that bill, well, it always comes due. Which brings us to the final, critical question. With everything balanced on a knife's edge like this, what's the one thing, the one piece of data that could tip the scales tomorrow? And the answer is the U.S. February Consumer Price Index report. That's it. It all comes down to tomorrow morning's inflation data. This one number could validate the market's AI dream and send everything soaring, or it could be the pin that pops the bubble, igniting those stagflation fears and bringing this whole paradoxical market crashing back down to earth. We're about to find out.